Today we've got John Medcalf back with us, and we're going to be talking about mortgages, which one might be better for different types of buyers, and help you pick the right one for your situation. Hey John, thanks for being here.
Thanks, Joe.
So we're going to be talking generally about mortgages. Of course, we got to give the disclaimer that we need you to get in contact with a lender so that they can look at your specific situation to make sure that it's the best for you. We're just going to give general advice for you about typical scenarios that apply today. And of course, mortgage terms change all the time. So
Yeah.
a little disclaimer, but just reach out to John, johnmedcalf.com. He can look at your situation and give you advice that's right for you. So, John, first of all, let's talk about what's in the mortgage payment. What's all included in that. What things do they have to pay separately?
Yep. So typically your mortgage payment consists of your principal and interest payment, which is amortized over 30 years. There's a little misconception with that. That's what doesn't change for 30 years on a fixed rate.
Right.
Also attached, if you're escrowing on your mortgage payment, is your homeowner's insurance and your taxes.
Sure.
Those taxes obviously change from property to property. Homeowner's insurance is all dependent on the client, on what they get their premium at.
And those numbers can change a little bit.
Yep.
But it's not like it used to be with ARMs where the whole payment would shift dramatically.
Very true.
Principal and interest will stay put with a fixed rate, but just the homeowner's insurance and property taxes can go up with the market.
And you also, if you have less than 20% down, there can be monthly mortgage insurance
Right.
on it too as well.
Sure.
And if you have a townhouse with association attached to the neighborhood, there can be some association dues there. Those typically are paid separately to the association.
Sure.
But yeah.
Not always.
Not
Can be
always.
Together or separate. So there's just something to look for if you're looking for a townhouse or a condo. You've got to factor in the association payment and know whether that's in the one payment you make to the mortgage company or if that one's separate.
Yeah, and we do work the association into the qualifying to make sure that the client can afford it.
Sure.
So that's worked in there too as well. You just paid separately.
Sure.
Out to the association.
But then utilities. People ask about that. That's not a part of the mortgage payment.
That is not part of your mortgage payment, and that is something that's paid separately. Your electricity, your water, your gas, all that stuff is you're going to pay it to whoever you set it up with when you buy the house.
Perfect.
Yeah.
Okay, so let's talk about different types of mortgages, which one's right for different people. Everybody's heard of the different types, but they don't know what they're for.
Yep.
So why don't we start with conventional? That might be kind of the best case scenario, ideal buyer, if you will. Talk to us about conventional.
So a conventional program is going to be somebody with a little bit on the higher side for credit.
Sure.
It's going to help keep that monthly mortgage insurance down if they're putting less than 20% down.
Sure.
Or maybe they're selling a house and transferring some equity over from a sale of their house. And they do have 20%, so we're definitely going to want to go with a conventional mortgage there.
Yeah.
The benefit of conventional mortgages are if you have higher credit, you can avoid that monthly mortgage insurance or the upfront mortgage insurance altogether if you do have enough to put down.
Sure.
It also benefits the buyer too with property conditions.
Yeah, doesn't have to be.
Yep, they don't necessarily have to be completely move-in ready. They're a little bit less strict on that than other type of government loans.
Yeah. So if you're looking for a house and it needs a little bit of work, we might be able to get it in approved with the appraiser and all that with a conventional product versus FHA, which we'll talk about next. So conventional. A little bit cheaper over the life of the loan with the PMI in that. But you have to have better credit and usually more money down to get into the program, generally. So let's talk about FHA. They are the ones that are real strict on the property condition. What type of a buyer and situation is best for FHA?
Yeah, FHA sometimes, we do see a lot of first-time home buyers that use FHA just because it doesn't require as much as a conventional mortgage for a down payment. The kind of hitch with FHA is there is upfront mortgage insurance and monthly mortgage insurance, and now with the new rules that is for the lifetime of the loan. Other than the mortgage insurance on it, you do have a higher qualifying ratio. So typically borrowers can afford a higher purchase price and monthly payment with an FHA loan versus a conventional loan.
So it's a little bit more expensive with the PMI in that to get the product, but people with lower credit score will be able to qualify, which is nice, and they'll be able to qualify for a little bit higher percentage of their income. So there's kind of some pros and the cons.
Yeah. So it's really there to kind of help some people with not bad credit, just a little bit lower credit and not so much money in the bank to help them get into a house and start building some equity.
Yeah, absolutely. And the property condition does have to be a little bit nicer. Peeling paint, handrails, those sorts of things that are fairly small and insignificant can blow up the deal with FHA.
They definitely can.
So let's talk about people that are wanting to put in some sweat equity. They're wanting to do a little work to the property, maybe get something that's a little bit rough. Everybody's watching HGTV these days, and they want to take that piece of work of a house a little bit and then make it something really nice. What
Yep.
products would work better for them in that situation?
So for that situation, we do rehab loans here at Marketplace.
Cool.
We do government FHA rehab loans and conventional rehab loans. There are different qualifying for both, especially loan to value, how much you're financing versus what the property's worth, as well as down payment requirements for the two different types of financing. But it's a good way for somebody who maybe loves the area that they're in but can't quite find that house in their price range. They can find something that's a little bit cheaper, get some money to finance the repairs to the home, or maybe an addition that you want on the home or something like that, to find the location that you want and be able to build the house that you want to as well.
And if you find that perfect house but the furnace doesn't work, you may be able to just roll that into mortgage, get it for cheaper, put that on the top of the mortgage basically. So it'll give you a lot more options, especially in a market like we've got now, inventory is low. You got to think outside of the box a little bit, and so that's good for just getting simple repairs done to make the appraiser happy, just to get the loan. Or if you're also wanting to make big improvements, it's good for either of those situations to go with a rehab loan.
Absolutely.
Cool.
Thanks.
If you have more questions, we've got a whole ton of frequent asked videos just like this one. Just visit joecarmack.com/blog, and you can find a whole bunch more. I think we got 20-something. How much does it cost to buy a house? What's that process look like? What are buyer consults? Everything that you're wondering, we've got online for you. So go check that out. And if you want to get in touch with John, he's our preferred vendor out of our office at Marketplace. And so visit johnmedcalf.com. Thanks so much.
Thanks.